Wall Street is currently holding its breath. Behind Nvidia's record-breaking revenue forecasts for 2026, a massive revenue trap is forming. While retail investors are cheering for the $200 price target, institutional funds are quietly analyzing a $500 billion visibility wall that most people are completely misreading. Nvidia just entered 2026 with a market cap of $4.5 trillion. That valuation assumes everything goes perfectly. But, as Jensen Huang revealed at CES 2026, the transition to the Rubin architecture isn't just a hardware upgrade. It's a calculated financial maneuver to lock in $500 billion in orders before the AI bubble can even think about popping. Today, we're breaking down the hard numbers behind the $500 billion backlog, the Rubin cost disruption, and why Nvidia is about to become the most profitable company in human history, or the biggest valuation trap of the decade. The numbers are staggering. CFO Colette Kress recently confirmed that Nvidia now has line of sight to over $500 billion in revenue through the end of 2026. This isn't just a projection, it's a backlog of confirmed orders for Blackwell, the new Rubin GPUs, and the networking fabric that holds them together. To put that in perspective, that's more than the annual GDP of most developed nations. But here is where the trap lies. This $500 billion visibility has created a valuation floor that makes the stock look safe. But for a company worth $4.5 trillion, $500 billion in revenue is actually the minimum requirement just to stay at the current price. For Nvidia to hit the $7 trillion market cap that analysts are now predicting for late 2026, they don't just need to meet this demand, they need to find a way to grow beyond it. The market has priced in perfection, leaving zero margin for a single supply chain bottleneck at TSMC or a slowdown in hyperscaler spending. The Rubin disruption, killing custom silicon, 245 to 415. The most significant moment of January 2026 was the launch of the Rubin platform. Rubin isn't just faster than Blackwell, it is 10 times cheaper to run. At CES, Nvidia demonstrated that Rubin can slash the cost per inference token by 90%. This is Nvidia's financial moat. By making AI inference 10 times cheaper, Nvidia is effectively killing the custom silicon threat from Google, Amazon, and Microsoft. If a company can buy a Rubin rack and get 10 times the efficiency, why would they spend billions developing their own chips? This move secures Nvidia's revenue through 2027, but it also forces its customers into a cycle of infinite capex. To stay competitive, big tech must buy Rubin, even if their own internal AI chips are starting to look like expensive distractions. For Nvidia shareholders, this is the ultimate vendor lock-in. The profitability milestone, passing Alphabet, 415 to 545. 2026 is the year Nvidia makes history on a different front. Net income. For years, Alphabet has been the world's most profitable company, generating roughly $125 billion in annual profits. But based on the 53% profit margins Nvidia maintained throughout fiscal 2026, the company is on track to generate $170 billion in pure profit by the end of this year. This is why the stock feels unstoppable. In the first 9 months of the current fiscal year, Nvidia returned $37 billion to shareholders through buybacks and dividends. They are essentially using their massive cash flow to buy the market's loyalty. When a company is this profitable, it becomes a defensive play, a place where investors hide during market volatility. But this creates a crowded trade. When everyone is on the same side of the boat, the eventual exit becomes much more dangerous. To reach a $7 trillion market cap by December, Nvidia needs a 56% stock rally from here. That requires the world to believe that AI spending will not just continue, but accelerate into 2027 and 2030. Currently, the visibility wall only goes as far as early 2027. If by the end of 2026, we don't see a next-gen architecture beyond Rubin, or if the ROI for companies like Meta and Microsoft starts to flatten, the $500 billion backlog won't save the stock from a multiple contraction. We are currently trading at a PE of 46. That's reasonable for 50% growth, but it's a death sentence if growth slows to 10 or 20%. The trap isn't that Nvidia will fail, it's that it will succeed so well that there's no room left for the stock to go up. The Rubin era is the end of speculative growth and the beginning of the efficiency war. Nvidia has built a $500 billion wall to protect its dominance, but as a shareholder, you need to decide if you are buying a company at its peak or at the start of its most profitable decade. Are you holding for the $7 trillion dream, or is it time to take chips off the table? Let's debate the exit strategy in the comments. Subscribe to LogicMap for the hard numbers Wall Street won't tell you.